Welcome to my channel. In this video we are going to be talking about dissolution of partnerships. Dissolution is something like winding up. A partnership may be dissolved after some time because of the following reasons. Like a partnership may be put to an end because of the following reasons. First, when the partnership is no longer making profit, the partners may decide to dissolve the partnership, to put it to an end. Then secondly, by mutual agreement, whereby one or more of the partners reaches retirement, or if the contract expires, they can agree to dissolve the partnership. And thirdly, where the partnership has expanded to the extent that there is need for it to be converted into a limited liability company, they can decide to dissolve it and then convert it into a limited liability company. Then, by force of circumstance, for instance, where a partner dies or if the government intervenes, they can decide to dissolve it. Then disagreement among partners, it's not easy to work with people, so in case there is a lot of disagreement, they can decide to just dissolve the partnership. As a way of solving disagreements. On dissolution of a partnership, the partnership may be sold as a going concern. It may be converted into a limited liability company, or the business may completely come to an end, which is winding up. So on dissolution, three things can happen. A partnership can either be sold as a going concern, be converted into a limited liability company, or it may completely come to an end, which is winding up. A realization account is open to record all the assets of the partnership on realization. In our previous video, we talked about revaluation account, and we said revaluation happens when a new partner is admitted or when a partner retires or dies. But then here we are going to have a realization account, and the realization account is opened on dissolution of a partnership. The respective asset accounts are closed and debited to the realization account. As the partnership is being dissolved, dissolution expenses may be incurred and thus debited to the realization account. So in case of a realization account, we debit all the assets except cash or bank. We also debit the expenses, the dissolution expenses that are incurred during dissolution. Then, in case the partnership had any liabilities on dissolution, individual partners must pay for those liabilities. The partners' capital and current accounts must also balance with no closing balance since the business has to come to an end. Then let's look at the accounting entries on dissolution. On dissolution, we say the realization account. A realization account is opened and all assets except cash and bank balances are closed or debited. Corresponding credit entries are made in the respective asset account. So when we are preparing a realization account, the first thing we do is to debit it with all assets except cash or bank. And then credit the respective asset accounts. So we debit the realization account and credit the individual asset account. Then in case of any provision closed by the provisions account, in case of any provision like provision for bad debts, we debit the provision account and then we credit the realization account. Then in case of external liabilities settled, when liabilities are settled, we debit the liability account because liabilities are reducing. So we debit the individual liability account and we credit cash or bank because we are settling the liabilities using either the money in bank or the cash at hand. So we credit cash or bank because they are reducing with the actual amount paid. Then thirdly, for any reduction in the value of assets, e.g. discount allowed. We said assets reduced by crediting. Yeah, so we debit the realization account and we credit the individual asset account. Then for any reduction in the value of liabilities, liability is reduced by debiting, i.e. discount received. We debit the individual liability account and we credit the realization account. Then in case partnership assets are taken over by the partners, if partnership assets are taken over by partners, it means that the money for the assets has to be deducted from the partners' accounts. Yeah, so we debit the individual partners' capital accounts and we credit the realization account with the agreed takeover price. Then in case liabilities are taken over by partners, it means that the business has to compensate them later. If they decide to pay for the liabilities on behalf of the business. Yeah, so we debit the individual liability account because we are settling the liabilities, they are reducing. We debit the individual liability account and we credit the individual partner's capital account. Then in case assets are sold for cash, we are receiving money either by check or real cash. Yeah, so we debit bank or cash account because they are increasing. Then we credit the realization account. Then in case of dissolution expenses, we debit realization account, then we credit bank or cash because we are paying for the expenses using the money either in the bank or the money at hand. Yeah. The realization account is balanced off to determine either a profit or loss on realization. Yeah, and in case the debit side is greater than the credit side, that is a loss on realization. As we said that if the debit side is greater than the credit side in any account, just know that it's a loss. Yeah, so if it's the same case even in the realization account, in case the debit side is greater than the credit side, this is a loss on realization. And if the credit side is greater than the debit side, this indicates a profit on realization. Therefore, the profit or loss ascertained is to be shared amongst the partners using the agreed ratio. When a profit is made, it will be shared amongst the partners, and when a loss is made, it will also be shared amongst the partners. Yeah. So in case of a loss on realization, we debit the individual partners' capital account. We debit the individual's partners' capital account or current account because they will be paying for that loss, so money will be deducted from their accounts and we credit the realization account. Then in case of a profit on realization, we debit the realization account and we credit the individual partners' capital account because their account will be credited with the profits that they have shared. Yeah. Then transfer the partners' current account balances to their capital accounts. We have to transfer the partners' current account balances to their capital balances. The current accounts, they always show the transactions between the partnership business and the individual partners. And then the capital accounts, they most of the times show the capital contribution of the partners and the additional capital that is brought into the business. Yeah, so when we transfer the partners' current account balances to their capital accounts, in case of the credit balance on the current account, in case of a credit balance means that the credit side is greater than the debit side. Yeah, so in case of a credit balance, we debit the partner's current account and we credit the partner's capital account. Then in case of a debit balance means it's like a loss. The debit side is greater than the credit side. Yeah, so we debit the partner's capital account and we credit the partner's current account. Yeah. Then where any partner has a debit balance on his or her account, such a partner must pay additional amount to the firm's bank account so as to clear his or her debit balance. When a partner has a debit balance, it means that he spent more than he was supposed to. Or the money on his account is not enough to clear up for all his expenses. So he has to bring more money, in order for him to clear up his debts or his debit balance. And in this case we debit cash or bank because the partner is bringing in money. We debit cash or bank account and we credit the partner's capital account. Then in case of partners having credit balances on their capital accounts, credit balances, it means that they had enough money, they had more than enough money to cater for their expenses and they remained with some money on their accounts. So there must be sufficient funds on the partnership account to clear those credit balances. So in this case, it's the business that is supposed to give to the partner's money. So here we debit the partner's capital account and we credit bank or cash account. We credit bank or cash account because the business is spending. There is an outflow of money because they have to pay the partners in order for them to clear their credit balances. After all the above transactions, bank or cash account will self-balance, must automatically balance. So in the realization account, the cash or bank account will automatically balance. Thanks for watching. Don't forget to subscribe, like, comment, share with your friends, and watch my next video. We shall be having an example. An example about realization accounts.